Hi everyone, this is Dan Held, and today I'm going to talk about yield farming with Bitcoin. Everyone's been hearing about yield farming with all these other coins, but you can actually earn a yield on your Bitcoin, which a lot of people don't know. There's a couple different methods to do it. Each one has its own risks, returns, ease of use, and I think that as a hodler, as you have a larger and larger Bitcoin stash over time, and as that value grows, those who are more risky can choose to earn a yield with it. And that actually might make you hodl harder. So instead of having to sell, you could simply earn a return on your Bitcoin. Again, these all come with risks. So today I'm going to do a screen walkthrough and walk you through the different ways that you can earn a yield with your Bitcoin. All right, so this is my first time doing a live stream, so it's going to be a little funky here. So let's see, I got the next one. All right, let's see here. And there we go. I got the transition done. Hopefully that turned out all right. Okay, so I think a lot of people have heard about companies like BlockFi. And companies like BlockFi are classic lending and borrowing platforms. So today I'm going to cover 4 different ways to earn yield. The most familiar here is lending. The second is covered calls, which is a type of option. So an option is there's call and put options, and a covered call is a type of an option. And then we also have join market, so coin joins, being a maker for coin joins, and being a lightning node. Now, this article, so this is an article I put together, will be available on danheld.com. It'll be called Yield Farming with Bitcoin. And I'll also post a link to it in the bottom of this video, whether you see this video on YouTube, Twitter, or some other place. So without further ado, I'm going to jump in with, all right, let's close that out. That's the article in flight. I'm going to go ahead and jump into BlockFi first. So some of you guys have heard me talk about BlockFi before. BlockFi is kind of like a bank in a way. When you sign up with BlockFi, this is what the dashboard looks like. This is my personal dashboard. So for the last 14 months, I have put my own capital at risk at companies like BlockFi and LedgerX, selling covered calls, to dive into and explore, how you can earn yield with your Bitcoin and also how you can lose your coin. I mean, I am taking very, very real risks here by doing this. So BlockFi has a really nice interface. This is the current balance of my portfolio. So I've got 10 BTC in here. And so with this, what's really cool is that you can earn yield on your Bitcoin. And what BlockFi does is BlockFi takes your Bitcoin and they lend them out to other counterparties. These could be big hedge funds. These could be exchanges. And so you don't know who they've lent it out to, which is the real risk here. You really don't know what counterparties that they've given these loans out to and what their creditworthiness is like. You hope that they have their risk management down properly. And so to earn a return, you deposit Bitcoin. So I sent in Bitcoin, so I deposited Bitcoin. And then this is the current interest rate that I earn. And their rates vary. They vary per crypto asset. If you take a look here, they've got the different tiers. So for your first 2.5 Bitcoin, you earn 6%. For any above 2.5 Bitcoin, you only earn 3%. Other coins have different interest rates. Litecoin's got 5%. Stable coins have a very high interest rate. These are all determined by the market. BlockFi simply looks at what the market's willing to pay for these loans in terms of the interest rate, and they pass on, they're going to capture a spread, and they're going to go and try to offer you an attractive yield, so you'll deposit with them so they can then loan out your coins. But yeah, so this is what it looks like. I'm not sure how many people have seen this, but what's really cool too about BlockFi is that you can earn a yield in whatever asset you like. You can earn yield in Bitcoin. You can earn yield in dollars. So I've played around at this where I earn yield in GUSD. There's no rhyme or, I don't really have like a good reason why I do this versus USDC. I think it's just more of me experimenting and playing around. So this is some of the fiat that I've earned from my Bitcoin. Yeah, you can earn yield in any of these crypto assets or non-crypto assets like these stable coins. Well, they're crypto assets, but stable. And then once you earn a yield there, this balance is earning a yield as well. So I'm sure a lot of people here are familiar with the idea of compound interest. So you're earning interest on your interest. Same principle applies here. You earn interest on the interest that you earn, or you can withdraw it. So I can quickly withdraw this and take it and go deposit it at any other exchange I'd like, and then withdraw that for fiat. So that's the first topic that we're going to cover is lending. One more thing here. So with BlockFi, you've got a bunch of different counterparties that you don't know, who BlockFi is lent to. There's another way you can earn yield by lending to margin pools, and Poloniex and Bitfinex offer this. Unfortunately, Kraken does not. I work at Kraken, and otherwise I would recommend that. One of the longest running and probably most liquid places to do this would be Bitfinex. Now, Bitfinex, you see over here on the left-hand side, you can earn an 8% return on your Bitcoin if you deposit Bitcoin at Bitfinex and then lend them out to the margin pool. Now, this comes with risk. Bitfinex got hacked back in 2016, and some people lost some money. I forget exactly how it got broken out in terms of like who was paid out, or if you were lent out your coins, if you had to take a loss. People didn't lose all their coins, but certainly a risk there. So that happened 4 years ago. And then we also have a recent incident last year at Poloniex. So this was with a crypto asset called Clams, which I'm not exactly sure what that was, but there was a auto liquidation issue that occurred. So when you earn money via lending, you're lending your money to a certain counterparty. With BlockFi, you don't know who the counterparty is, but they are lending out to many counterparties, so it's unlikely that all of them default at once. This, again, isn't guaranteed. We, again, don't know how BlockFi manages their risk. And then for Bitfinex, we do know our counterparty. We know it's Bitfinex. And whether or not you think they have a great reputation is subjective. So if you think they have a great reputation and you trust them, then maybe you would want to lend them your coins. So those are the two ways that you can earn a yield on your Bitcoin with lending. And in the article, there'll be links for BlockFi and Bitfinex if you want to sign up and check that out. So I also, in my analysis here, put together kind of a simple matrix of yield, type of risk. So if you're a more visual person after this stream, you can go check it out. Liquidity, how easy can you get in and out, and ease of use. Now there's also other platforms as well. There's Genesis Capital. So you can lend out your Bitcoin to very large institutional counterparties, but you have to have a minimum $250K deposit with them. So I'll add them in here as well, but that's an option for the more sophisticated, bigger type investors. All right, so now we're going to jump into covered calls, and this is something that I've spent a bunch of time digging into, and I find personally fascinating. Not many Bitcoiners have really explored covered calls at all. I think there's a lot of mystery behind options where I think when we hear the word options, we imagine like a whiteboard full of like calculus and shit. Like it's essentially, you hear the word options and you think complicated. But actually, selling options isn't as complicated, and you're not certainly day trading them. So, what I'm propositioning today in terms of earning yield, and this is a very common thing to do with equities. What you can do with Bitcoin is you can sell a covered call. So you are selling someone the option to buy your Bitcoin from you at a certain price at a certain date. Now, if the price is lower than the strike, and that's that certain price, if it's lower than the strike, then you get your Bitcoin back and you earn your premium. So the buyer of this call option, they give you money for the optionality to buy your Bitcoin from you at a certain strike or above. If Bitcoin is above that strike price, then they will likely exercise their option to purchase Bitcoin from you at a certain value. So instead of me jabbering on about how this works, let me just show you with LedgerX. So this is my LedgerX account. I just put a little bit of money in here to play around. I think with all of this, be safe. Try it out yourself with a little bit of money so you don't fuck up too badly. Develop trust, develop a better understanding of the risk that you're taking, and then go do it. So what's really cool about LedgerX is, let's say, and these are actual numbers as of today. Actually, I'm recording this a little bit before, but as of, let's see, we got, essentially as of a little bit ago. We've got a slight delta here. So let's take a look at, here's kind of a fun one. Let's take a look at December 2018. And if we do December 2018, let's say you want to, and I'm going to pull over, here we go. I'm not sure. Oh, okay, this calculator isn't visible. Let me make this calculator visible here. 1 second. Now we have, okay, so here we go. Now we've got the ability for you guys to see a calculator that I've got open here while we can do some back of the envelope calculations. So let's take December 2020 covered calls. So that's the expiration is December 2020, and we've got different strike prices. So that's $2,000, $5,000, $7,000, $20,000, $50,000, $100,000. So those are certain prices of Bitcoin at certain dates, which the date is December 18th, 2020. So let's take a look at if you sold, if you split the difference here between the bid and the ask of the $40,000 calls. All right, so you've got 230. Oops, sorry, I got my microphone here. So 230 plus 100 divided by 2. All right, so 160. So what you would get, so here's the $40,000 strike. This is the bid and the ask, and here's the depth. So that looks like a pretty strong depth at 100, but let's split the difference. So I split the difference here. So let's say you could get filled at $165 per Bitcoin at a $40,000 strike. So what is your annualized yield? So you take the 165 and you divide that by the current price of Bitcoin, which is 10,898, and you get 1.5%. But we've only got, let's see, it's September. Yeah, so September, October, October to November, November to December. So that's 3 months. So that's only 1/3 of the year. So if you annualize that, that would be, all right, so that's times 4. So you're earning a 6% yield, which is pretty sweet. 6% is in line with the BlockFi and Bitfinex rates. But what's cool about this is that you have no counterparty risk. Sure, you have an exchange risk of LedgerX getting hacked, but I think that's much lower than a lending risk or a trade execution risk. So, with Bitfinex and Poloniex, it's true that they can get hacked as well, but they have the additional risk of the risk management system failing. And that happened with Poloniex, where they lost $15 million because of it. So what's really cool about that is 6% is pretty sweet, given that here's what happens on December 18th, 2020. Or here's what happens from the moment you do this trade, and I'll actually do this as well. All right, so I'm doing, these are priced in minis, so 100 contracts equals 1 Bitcoin. So if I'm willing to sell, let's see, what's the price? I got 230. Okay, let's do it at okay, cool. So yeah, so if I do it at the 165 split, so there's my order now. So now I've moved the inner bid ask. So now the ask my open orders. Now I can cancel that, so that's a limit order. But let me go ahead and do. I'm going to sell 1/10 of a Bitcoin. All right, so still getting used to my setup here. What I'm going to do is I'm going to go ahead and calculate what you would earn on your Bitcoin if you were to sell a $40,000 strike. So as I calculated before, it's got a 6% yield, annualized yield. But the bet that we're making here is that Bitcoin will not be above $40,000 in December. Ideally, I would not want to sell my Bitcoin even at $40,000 of Bitcoin. So at December 18th, 2020, if Bitcoin is below $40,000, I keep my premium. So I've been paid, if we split the difference here, I'd be paid $165 per Bitcoin for 3 months. and I would get to keep that and keep my Bitcoin if Bitcoin is below $40,000 on December 18th, 2020. Now, if Bitcoin is above $40,000 on December 18th, 2020, I keep my premium, but then my Bitcoin can be sold at $40,000 no matter how high the price is. So I'm selling upside. That's the TLDR here, is I'm selling any upside above 40,000. Now, this is where it becomes very subjective in terms of risk reward. Do you find that the risk of Bitcoin being above that price is worth the compensation that you're being paid in the premium? This is something that each person has to explore on their own and see if it's something that they're comfortable with. What's really fun is that with covered calls, this is what I pulled the other day. So I pulled this the other day. I think this was about a week ago. The prices of these options trade every single second, so they change constantly. And options pricing is a very complicated sort of spectrum of different mechanisms in terms of how it's calculated. But essentially, you're paying, the buyer of the option is paying for the optionality, and the closer you get the optionality to either buy or sell the underlying to you. And so when we look at how options are priced, and so here, I'll go back to my options dashboard. So let's look at, right now we're at, let's see, the current price of Bitcoin is around 10,885. So let's just round that up, or we could round that down. Let's round it up to $12,000 of Bitcoin. So you notice that the amounts here are a lot higher. These are a lot higher. The premium that you earn is, really high compared to, the $40,000 strike. And that's because the option purchaser prices in the much higher likelihood that the price of Bitcoin will be above $12,000 by December 18th, 2020. And so they're willing to pay you a much higher premium for that optionality. And, just doing some back of the envelope math here, you're looking at a good 10% in 3 months. So you would earn 10% on your Bitcoin in 3 months. Annualized, that would be around 40%, which is pretty phenomenal. So this is a really cool strategy. If you've got Bitcoin, you have to sell them because you're buying a house, you're buying a car, or you just want to earn yield. So if it's useful for a couple of reasons. One, if you want to earn yield, you can look at really out of the money. That's what we call any option that is currently above the current price of Bitcoin. Any strike that is above the price of Bitcoin, or far below. Just above. That's in the money. At the money is the current price. And so if you want to sell very out of the money covered calls, you can earn a yield on your Bitcoin with very low risk that you would have to sell your Bitcoin. You can also earn a yield on your Bitcoin as you get closer and closer to the current price. When you do that, you earn a higher and higher yield, and due to Bitcoin's implied volatility, or how much investors are pricing in Bitcoin's volatility, that can be really juicy. This is a really lucrative option for people who want to earn yield, and or they have to sell Bitcoin because of a life event, kid, car, house, and you want to capture that extra premium in the meantime before you have to sell your coin. So if you're willing to wait a few months or just a month, because these expirations are staggered on a monthly basis, so you can sell them for end of December, October. And so if you did that, you could, it depends on how long or how quickly you need your money, but it's a really lucrative option to earn extra yield on your coins if you have a for sale event or just want to live off of the income. LedgerX is really fun because you can look very, very far away. So let's take a look at expirations in December 31st, 2021. That's a long time from now. When we look at the strikes here, so we have $10,000 strike, $15,000. Let's just look at the $10,000 strike to make the math easy here, so we can just kind of easily put this together. This amount is a lot of money. So you're looking at a 50% premium. So if you're willing not to be paid, so if you're willing to lock up your coins until, for a year and a quarter, you can earn 50% of the value of your coins today in a premium. Now, what's the likelihood that Bitcoin will be above $10,000 on December 31st, 2021? Well, it's very high because that's why most investors believe that is a very, very likely event. That's why they're paying you that premium of 50%, because they're like, well, we all think that's a very likely event, and so I'll pay you 50 cents now because I think it'll be way above that later. So that's the reason why this premium is so juicy. But if you want to sell these covered calls and wait a year and a quarter, that's super juicy income that you can use. What's really fun too is that anything longer than a year, any option longer than a year, this becomes long-term capital gains. I'm not a CPA. Double check on this depending on your local jurisdiction, but I'm pretty sure it's long-term capital gains if you sell an option with a expiration longer than a year. So that's options. And here I'll go ahead and we'll go look at December 18, 2020. I'll go ahead and sell one, and I'll cross the bid here so it'll get executed. All right, let's see. Yeah, it looks like it. Okay, 1 second. All right, so there we go. Collected that $1 premium. Sold one mini. So remember, these are 1/100th of a Bitcoin at $100. So I just did this to make it easy so you guys could see how it works in terms of how that works. So I can take that dollar and send it anywhere I want. It's not locked up here. But yeah, if I wanted to, here's the depth of the book. I could sell quite a bit more. Of course, like there's the bid and the ask, and then there's quite a bit of a spread there. So you could split the middle, or maybe you take your ask and you move it a little bit closer to the bid and hope that they come and execute against you. So LedgerX is a platform I've used before. We also have Deribit. So Deribit is the most liquid options exchange out there. If you notice, some of the depth here isn't super deep. This is only 10 Bitcoin. So, of course, there's other, you could do OTC. I think that's a little riskier. Deribit is a very, very popular exchange. This is the most liquid options market out there. As you notice, they have different expirations and different strikes, and then they have the bid ask. So same principle applies here. I use LedgerX and Deribit. I wanted to show off LedgerX because it's a little bit easier to see and visualize versus here. And then finally, the way that I monitor the options market is through a company called Skew. Skew is a great free tool where you can build custom options dashboards. And for example, like implied volatility is how these options are priced, how all options are priced. So this is how I monitor and look at, just kind of keep an eye on the market. This is total open interest. And here's option volumes, so amount executed. And then here's realized volatility versus implied volatility. So implied volatility is what investors are pricing in as the future volatility. So it's what we all expect volatility to be, whereas realized volatility is what actually happened. And you see that in these moments, it's pretty rare where realized volatility is higher than implied. There's different ways to trade options. Your ideal situation is to sell your covered call when implied volatility goes up. Like these moments earlier in March here, as everyone remembers, we had the big dip. In those moments when implied volatility skyrockets, the premium on the call options become enormous. This is because the volatility increases the probability of certain events happening. So that essentially makes the premium that you can command to sell someone that optionality much higher. So that's the TLDR on covered calls. You're potentially selling upside. I monitor it here on Skew. I trade it on Deribit, LedgerX, both great companies. LedgerX is the deepest liquidity in the space. Deribit's the deepest liquidity in the space. LedgerX is probably the more simple interface. And so now we've covered calls. So we've covered two things. We've covered lending and covered calls as to different ways you can earn yield on your Bitcoin. They have different risks. With covered calls, just to wrap this up, you've got the risk of the exchange being hacked or the price of Bitcoin going higher than your strike. If it goes higher than the strike, then you would simply sell your coin at that strike price. Now, with the example we used earlier at the $40,000 covered call strikes, you're selling your Bitcoin at $40,000. So it's not necessarily a terrible thing. Like, you 4x'd your whatever value of your Bitcoin, whatever number of coins you sold covered calls for, like you're not selling those at the current price. You're selling those at that strike of 40,000. So you still capture some of that upside as well. You're just selling any upside above 40,000. So yeah, covered calls I think are really interesting and exciting, and not many Bitcoiners have explored it. And now for the next section, which is CoinJoins, using a tool called JoinMarket, which is an open source marketplace for CoinJoins. Bitcoiners can earn a yield by making the CoinJoin. So when someone wants to mix their coins, the taker, they need to find a maker, someone who has coins they want to mix, in order to obfuscate their coins. So the taker will offer, so someone who wants to mix their coins offers another individual money or Bitcoin to mix their coins with them. And that's what JoinMarket does, is you can earn a yield on your Bitcoin by mixing it with other people's coins. Now, the yield on here is really variable. What I saw on a few old Reddit posts were people showing their different yield generations annualized. Saw a lot between like 0.8 and 1%. I've talked to a few individuals who would like to remain private, but they say that they're earning about 0.5% now. So I think that you're not going to earn a ton of money with this. There's a lot of other issues as well. For example, liquidity. So if you look at the order book, which I believe it's down right now, but it's not connecting for me, but you can see the live order book typically for CoinJoins, and what that will show you is the number of other individuals who'd be willing to mix with you. And so if you're trying to earn yield on money on like $1 million+ worth of Bitcoin, you're just not going to find that here. And then the ease of use, I would say it's a little bit harder to use than most. I've linked to running a yield generator in tutorial here, which is how to run. There's a yield generation function within the JoinMarket software, which takes your Bitcoins and automatically places orders, maker orders, so individuals can come and take that liquidity. So, I think kind of the last component here, this is a really safe, in terms of like all of the risks of all the other types of ways to earn yield, I would say this is the lowest in terms of technical risk and, risk over your funds, because essentially this is like this, you don't have to trust any other counterparty. This is all open source software. You are keeping a hot wallet, which a lot of people do anyways. So there's a level of risk with that. There is a regulatory risk. This might be considered activities that are illegal in some countries. So you'd want to, go double check your local jurisdiction and double check if that activity is permitted. Up to you to decide to adhere to that or not. And then the final method to earn yield is running a Lightning node. So when you run a Lightning node, to incentivize the routing of payment, the nodes are given a small fee. And the yield generated from that is there's a wide variation here. I really couldn't get a good number on it. BitMEX, through their own research in terms of they actually ran a Bitcoin node, they saw that it was about 1%, but that was a long time ago. I've heard almost nothing as the yield. Some other folks say that they haven't really earned much at all. I would say whatever the yield is, it's probably much lower than the other options. The risk is somewhat high because Lightning is a little bit new in terms of software. So there's a bug that could occur where you could lose your funds in that channel. I don't think it's super likely, but I'm not, I don't know which zero-day exploits exist and which ones might impact your node that's running. Liquidity, there's just really not that much liquidity. So to earn a yield on, a large amount of money, it's going to be really tricky to earn that consistently. And then ease of use is probably on the higher end. You're going to kind of constantly have to monitor things and maintain things. I know that different engineers in this space have built automation tools, which help with this, but it's pretty tricky. And if you want to get started running a Lightning node, I would recommend checking out Pierre Rochard. He has got a really easy to use guide here on how to get started with Lightning. But yeah, I think that it's a pretty interesting way to earn a yield on your Bitcoin. Up to the individual individual person here to determine which one they want to go with. So that there you have it. You've got Lightning, join markets, covered calls, and lending as the ways that you can earn yield on your Bitcoin. If you want to learn more, if you want to check out, I uploaded this document into my blog. If you want to check that out, it's on danheld.com/blog and called Earning Yield Farming with Bitcoin. So check that out. I've got links to all the things that I showed you in here in terms of like the different ways you can sign up for different products and different services and guides on how to get started with CoinJoins and Lightning. So yeah, let me know what you guys think. Give me some feedback. So depending on where you're watching this, either tweet at me or reply in a comment on YouTube. But thanks for watching, and I'll see you again in another episode. Cheers.